You're sitting there, staring at two numbers on your phone. One is your loan balance, the other is your investment account. And you're thinking, okay, if my debt is 6% and the stock market averages 8%, then obviously investing wins, right? So you feel smart, logical, rational. But then you still feel unsure because somehow, even after doing the math, the decision still feels wrong. If that's you, yeah, same. And that feeling, that's where most people go off track. My name is John, and I spend way too much time thinking about how people compare debt and investing, and why they almost always do it wrong. And if you're someone who's stuck choosing between paying down debt or investing, constantly running numbers but never feeling confident, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about the one mistake people make when comparing debt and investing. And once you see it, you'll never look at this decision the same way again. Here's the thing. Most people think this decision is just math. Debt interest rate versus investment return. Whichever number is higher wins. Simple. Clean. Wrong. Because that comparison ignores how money actually behaves in real life. The mistake is this. People compare debt and investing as if they're equally certain. They're not. Not even close. And this is where it gets really interesting. When you pay off debt early, you are getting a guaranteed return equal to the interest rate. A 6% loan paid off early? That's a risk-free 6% return. Investing? That 8% average everyone quotes? That's an average, not a promise. Some years you're up 20%. Some years you're down 30%. Your brain treats these as equal. The market does not. According to J.P. Morgan's long-term market data, the S&P 500 has averaged about 10% annually over the last century. Sounds great. But here's the part nobody mentions. In any given single year, market returns ranged from plus 50% to minus 40%. Debt doesn't do that. Let's say you have $15,000 in student loans at 5%. $15,000 ready to invest. Paying off the loan gives you a guaranteed $750 per year in interest savings. Investing that $15,000? On average, maybe you earn $1,200 per year, but in a bad year, you could lose $3,000. Same money, very different experience. Your brain doesn't care about averages, it cares about volatility. Losses hurt roughly twice as much as gains feel good, according to behavioral economics research by Kahneman and Tversky. So when people say, I know investing should win, but I hate seeing my balance drop, that's not weakness, that's biology. Comparing debt to investing purely by numbers is like comparing a salary versus a freelance income with higher upside but unstable months. One is boring and predictable. The other might make you richer, but can mess with your head. Now you might be thinking, okay, John, but if investing wins long term, shouldn't I just ignore the emotions? In theory, sure. In reality, ignoring psychology is how people quit investing at the worst possible time. Here's the pattern I see over and over. People choose investing over debt because the math says so. Then the market drops. They panic. They stop investing. Now they still have debt and no momentum. The comparison failed because it ignored behavioral risk. Debt reduction lowers stress, improves cash flow, creates stability. Investing builds wealth, requires patience, demands emotional discipline. Treating them like they're interchangeable is the mistake. I've seen people rush into investing while carrying debt they secretly hated. They watched their portfolio fluctuate, and instead of feeling empowered, they felt trapped. So they quit. The math was right, the strategy was wrong. Instead of asking, which return is higher, ask,
Is this debt emotionally heavy? Can I invest consistently through downturns? Will this choice increase or reduce financial stress? Because consistency beats optimization every single time. Here's a simple test you can actually use. Step 1. List all debts and interest rates. Step 2. Mark which debts cause stress, not just cost money. Step 3. Pay off high-stress, high-interest debt first. Step 4. Invest alongside low-interest, low-stress debt. Step 5. Never choose a strategy you can't stick with for 10+ years. Look, optimizing spreadsheets while ignoring behavior is how people stay stuck. Wealth isn't built by perfect decisions, it's built by repeatable ones. The one mistake people make when comparing debt and investing is forgetting that you are part of the equation, not just the numbers. Your emotions, your habits, your consistency. That's where the real returns come from. If this video helped reframe how you think about debt and investing, hit the like button. It really helps this channel reach the right people. Subscribe if you want calm, realistic money advice that actually works in real life. And comment below, what stresses you more, debt or market volatility? I'll see you in the next one.
If you like the video, hit the like button and subscribe to my channel to get new updates.